Breakouts are the single greatest setup in the entire market, but 90% of them are traps. They've built entire trading careers on their own, but they've also blown the most accounts, because nearly everything that happens in the market is random, unpredictable, and choppy. You have absolutely no edge and no way to profit consistently. You're just in a cycle of gaining a bit of profit and waiting to give it back. But there are a few times where you can see the market clearly, and that's during breakouts. When the price breaks above a key level, that's the market telling us that one side has taken control of momentum, and therefore it's likely to keep moving in that direction. And this has all the characteristics of a perfect trade. It's high probability, it's low risk, and it's high reward. So it has a high chance of playing out. If it does work, you'll gain a lot. If it doesn't work, you'll lose a little. And I mean, besides being able to literally look into the future, this is the best thing you can possibly ask for in trading. So breakout trades are explosively powerful to grow an account, but only when they're done properly. Because if you trade them the way most traders do, you'll end up with none of that. You'll just get caught in the chop again. Making real money from breakouts isn't about taking everyone you see. It's about filtering. Once I learned this, breakouts became my entire strategy, and now they make me 1 to 3K almost every single day. So in this video, I'm going to break down the exact process that I use to catch clean breakouts, step by step. And just a quick disclaimer before we start, this isn't financial advice. I'm just showing you what works for me. If you decide to use it, trade at your own risk and size properly. So let's get into it. Take a look at this chart. How would you trade this? Well, if we were looking to trade breakouts, then just trading them randomly would ruin our chances from the start. We see that every single breakout attempt here fails. If we're looking for a trend continuation after the previous breakout, then we see that it fails and drops into a consolidation. Then if we try to switch our bias to bearish and look for a breakout to the downside, that fails as well. And if we try to switch again to our original bullish bias and look for another break higher, well, that fails too. So if you're just looking to trade any breakout, you can see how quickly the losses stack up. And the critical mistake most traders make here is abandoning the breakout strategy completely and trying another setup. But that'll give similar results, if not worse results. Because the key isn't the setup itself. It's knowing which setups to take and which ones to avoid. We already saw that breakouts are essentially the best trade you can ask for because they're high probability, low risk, and high reward. It's not like taking a range trade that has a low risk reward and a low chance of working. And it's not like taking a reversal setup which could be high risk reward but also has a lower chance of working. This has trend, momentum, and structure on its side, so we know we're in the right vehicle for a consistent, profitable setup. Now, we know that taking any random breakout will not result in consistent gains. Trying to trade as you go and just off your gut feel is probably not the best idea. So we need the right structure in place before we even consider entering a trade. The first thing I do is mark supply and demand levels. These are not just any levels, they're volume-based and structure-based. Think of it as a pocket of liquidity. This specific chart is the ES, and on the ES, there's going to be a liquidity pocket every 20 to 30 points that the price is drawn to. Once the price is in a liquidity pocket, it'll be drawn to the next one, either above or below, and this is how the market moves. Actually, I'll link a video here that tells you precisely how to find and mark these levels, so you can watch it after this. It's only something you need to do once, then you can use them permanently. And the price will move from level to level with very high accuracy. So when it comes to breakouts, the only trades I'll even consider are trades that align with these levels. That's how we structure a real breakout. Now, this type of trading is known as LCE, or level, confirmation, and execution. This is the step-by-step process to taking level-to-level trades. We will first wait for the price to enter a level, then wait for confirmation that the price will move in our direction, then execute that trade. And in LCE terms, we just have two types of level-to-level trades. When we're at a level, we have one of two choices. The price will either move to the level above or the level below. If price moves to the level it just came from, that's known as a mean reversion trade. But this is not the type of trade we usually want to be taking, since it's a trade that returns to the range instead of breaking out of it. The other type of trade is a breakout trade. And as the name suggests, this is when we're breaking out of market structure and moving to the next level, instead of the one we just came from. So anytime price enters a level, we have a choice of one of these two trades. and we want to be looking for the breakout trade. So let's look at how to nail the execution on this breakout as a step-by-step LCE trade. So number one, we need to confirm that the price is indeed in a level. And when I say in a level, I mean the price should be at least halfway into the level or more before we even consider a trade. This tells us that the market is actually serious about breaking out of this level. We do not want to make the mistake of entering as soon as price touches the level. I mean, look at what happened the last two times it hit. So that's step one. Once the price is firmly in a level, we can move on to step two, which is cloud confirmation. Now, to actually confirm that the price will indeed break out and not simply fail and revert to the mean, we need confirmation that it's a valid breakout. We need to make sure that the odds are tilted in our favor. Now, this is where the EMA cloud comes in. This is just the EMA with 20 and 50 settings. And based on how it's sloping, we can tell whether the odds favor us or not. Since we're looking for a breakout here, we want the price to move to the next level above. And that means we need a bullish bias. And the cloud here is sloping up, which tells us that momentum, trend, and structure are on our side. Our case is even stronger if we align multiple clouds on different time frames. And I'll show you what that looks like in a second. But once the cloud points in the same direction as our breakout, we have enough confirmation that the odds tilt in our favor, and we can execute, which brings us to step three, the break. This is going to be our actual entry trigger. And for this, we want to see a break of the previous high. Not every breakout will have a recent high, and in that case, just enter roughly in the middle with enough confirmation. But if we have a previous high, we can use that as our entry trigger, like we see here. Now from here, we simply enter long. We're going to be targeting the next level and placing our stop under market structure near the cloud. Then we simply wait and let it run. You don't interrupt it or touch it at all, with just one exception. By the way, I've helped hundreds of traders apply this exact breakout strategy and get real results. This is what we do inside the LCE accelerator. You'll get direct access to me through weekly calls and a private one-on-one chat, so you can ask questions and get feedback on your trades anytime. You'll also get this exact level-to-level chart, and you'll be part of a private community of traders and a live trading room. If you're interested, the link is below. So you never want to touch the trade until it hits either your stop or your target, unless you want to move the price to break even when it gets nearly halfway to your target. This way, you preserve your gains without having the price run all the way back to your stop. Now let's look at a real example of this playing out recently. This is going to be on ES, of course, and we'll be starting on the 5-minute, around the time the market opens at 9:30 a.m. So we see that the price is going to be opening at this level, and the cloud here doesn't really have a direction. It's kind of flat and doesn't really point us one way or another. So we're waiting for a breakout here, but we don't know which side yet because the cloud on the 5-minute isn't giving us a direction. But if we go on a higher time frame, like the 1 hour, then we'll be able to get a clearer overall view. We'll be able to see if the market is really flat and has no direction, or if it actually does have a direction overall. And as we see here, the market does indeed have a strong direction. The cloud is sloping down heavily. And if we go on the 30-minute and the 15-minute, we'll see similar patterns play out. So what this tells us is that our overall bias should be bearish, and that we should be looking for breakouts to the lower level, since that's what's aligned with trend and momentum. Now let's see what happens when the market opens. And we see that something interesting happens here. The market tries to break out to the upside, but it fails. The higher time frame clouds are still negative, so they're putting a lot of downward pressure on the price. This is what I meant before by only taking breakouts that are aligned with the cloud. If we take breakouts that aren't aligned with the cloud, we're going to have a much lower success rate. So the upward breakouts failed. Then we see the price begin to drift down into our lower demand level here, and the cloud has also started to curl downward. In fact, it has flipped from bullish to bearish here. Now we have the higher time frame clouds which are bearish, and we have strong rejections here which built even more bearish structure. So using our LCE framework, let's see if this would be a valid breakout trade to the downside. We're firmly in a level, so that passes step one. Step two is that we want the cloud to confirm, and the cloud is bearish on all time frames, including this one. That passes step two. Now that means we can execute. We can either enter around the middle of the level or wait for a break of recent structure. And once we enter, We set our stop above market structure or right near the cloud, and we set our target at the next level. From here, we just wait for it to play out. And that's it. That's one successful breakout trade for the day. We can lock this in and come back tomorrow to find the next breakout trade. That's how I'm able to profit consistently without much effort. You wait for price to enter a real supply and demand level. You confirm the cloud is sloping in your direction. And you execute the break with your stop near the cloud and your target at the next level. It's just a clean mechanical process you can repeat every single day. And if you want help applying this, then be sure to check out the LCE accelerator below. Be sure to like and subscribe if you want more videos like this. I'll see you in the next one.